you. Good evening, everyone. Live from Nashville. It's Thursday, February 9th, 2023. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're glad you're with us tonight. Our theme for tonight is the bear dead. Well, it didn't look like it today, but so far this year, it's looking pretty good. And then the CB3 Investing Strategy Part 2. I had some questions, a follow-up set of questions from several people clarifying and wanting me to clarify our investment strategy, which started in January. So we might do another follow-up in the February show too, in the March show after tonight, in case you guys have more thoughts or more things you'd like to know about how I invest your money, those of you that are clients. Okay, so these are the topics we cover every single month, and we'll hit most of them tonight, if not all of them. We would recommend that you put a note on your calendar. Next month, I will be traveling on the second Thursday. So the show next month will be the first Thursday, which means that's 3 weeks from tonight, March 2nd. So that's wrong. The Thursday's correct, but we must have had the wrong year on the calendar when we were putting the slideshow together. Sorry about that, guys. March 2nd, Thursday, 3 weeks from tonight, will be the show next month. If you're new to the program, be sure to subscribe, click the little bell so that you get updates when we go live. Follow us on Twitter, Facebook, LinkedIn. I tweet almost every day, pretty much every day, I should say, sometimes twice. Didn't do anything during the State of the Union. I'll cover that a little bit tonight in the political section, but keep up with me there. So you guys know this chart. There's going to be a lot of data tonight, so you may want to play this back, okay, once you've watched this live and you want to zoom in on seeing this. But you guys know this chart, those of you that have watched the program. This is showing the last 100 years. We've only had 3 secular bear markets in the last 100 years, and there they are in red. And the rest of the time, we are in secular bull markets. I have maintained that since April 10th. 2013, we have been in a secular bull market with cyclical bear markets. The most recent one we're still in because we haven't taken out the highs from January 4th of last year. So we're now at a 13-month cyclical bear market. Not much fun, but look at the green. You're going to have to lean in there. You're going to see that little tick up there. So what I'll do is I will zoom in on the chart and show you. This is just the last 2 years. Okay, so the market high, January 4th, 2022. So, a little over 13 months ago. And when I talk about the downtrend has been broken, if you look in green there, that's because we pushed up through that downtrend. Okay, this cyclical bear market of 2022, a series of lower highs. This is a chart of the S&P 500. So look at the little yellow dots, right? So lower highs and lower lows. In other words, just going down. All right. If you connect those, you're going to see a downtrend, but that's been broken as of the last couple weeks. All right. Since I did the show in January. So that's encouraging. It does not mean that we are roaring back to the top of January 4th, 2022. And in fact, it could easily take the rest of the year to do that because there are going to be so many bears out there that aren't going to want to give up their positions of their short stocks, etc. So this could be another year of vacillating, but I think it's going to be vacillating to the upside rather than the downside. At least that's the data that I'm seeing. So what could this portend? Again, I know there's a lot of data on the charts here, guys, but what I really want you to take away is the column in red. So that's the percentage change that happens in cyclical bear markets. Notice that from 1957 all the way to the current day, these are all cyclical bear markets. All right. So there have been secular bear markets, but I'm setting those aside because I'm confident we're not in one, that we are pulling out of this cyclical bear market. And you can see what the returns are. So if you look carefully at the green, the 6-month return, 1-year return, 2-year return, they're all in double digits, right? 40, 43, 58, 42, 61. Really strong returns once we get out of the bear market. And I'm making a plausible case for that by showing you the charts saying that, yes, we've pushed above that downtrend that lasted over a year. Now, there's no data on the bottom where the yellow is because we don't know. It's 282 days, basically, since this bear market. If we go back to October 13, which was the low of the market, all right, that was the low of this cyclical bear market, down 27%, nowhere near the 38% we were down during COVID. Okay, so this is not as bad a cyclical bear market as we had during COVID just 2.5 years ago, really just 3 years ago, I should say. All right. So we're in pretty good shape. This is why I constantly tell you, don't listen to the media because they want eyeballs and they get eyeballs by scaring people. I'm giving you the actual data. All right. Triple sourced or at least double sourced. Now, this is a chart you see every week, or at least every month, I should say, when I present this. And this is the earnings reports surprises from the S&P 500. So we're at 250 right now. So half of the S&P 500 has reported. Once we get to the end of March 31st, then the fourth quarter earnings will end and the first quarter earnings, will actually start being presented in April, May, and June. That's how it works. So what I'm seeing is the S&P 500 at 70%. We want to see that at least 73. We're a little below that, but it's not a surprise with all the headwinds that the market's facing. What I like is that consumer discretionary is beating their expectations by 74%, healthcare by 87%, technology by 78%. Where we're really getting killed is in communication services. So the surprises by Amazon, by Google, just not helping at all. All right. And that's why you're seeing that. But overall, considering the market temperature, if you will, this is a good showing. So far this year, and now I can talk with a little more authority, I should say, than, we're 6 weeks into the quarter as opposed to 2 weeks when I did my last show. We've seen a nice rally. We're seeing a pretty nice rally. January finished as the strongest, among the strongest, I should say, on record. So the 9th best January since 1950. That puts it in the top quarantines, or quarantile, I guess I should say, not quarantine. All right, so there's 4 quarantines, right? So boom, 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 boom. And the highest, upper 25%, that's where this finished. And that's what we want to see. So the strong Januaries on the calendar almost always result in solid years. It's not a perfect science and certainly not a guarantee, but there's everything to say that history's on our side, especially the year after a midterm election. So we have a calendar bias, we have a January bias, and we have the fact that the cyclical bear market trend line has been broken. All right, those are the facts. I don't know why when you listen to the media, especially CNBC and CNN, and they talk so gloom and doom, why they don't see the same data that I do. But the point is, So there's two issues, all right? And I've actually talked to a couple clients this week where they're going, I'm a little concerned about my performance, and I get that. We're going to talk about this tonight. But the point is that there are going to be some years when we're in the back of the line and some of the years when we're in the front of the line. One of the years we were in the front of the line was 2007, for those of you that have been with me that long. 2017 was another really good one. 2020, we were up 63% in CG. Last year was an awful year. Now, I was performing about where the NASDAQ was, in other words, down almost 30%. Do not like those years, and we have made some changes. We'll get to that in the last segment here, so stick with me till the end when I talk about how I'm managing your accounts, okay? But just because we call ourselves trend followers doesn't mean we're going to perform similarly year after year after year. And in fact, we're likely going to have a variance over a lot of reasons: portfolio composition, trade timing, socioeconomic matters that are going on, wars, certainly political influences. All of these can affect performance, all right? So this is pulled from my Interactive Brokers statement when we moved our RIA over from the previous broker-dealer. We started at Interactive Brokers in 2011, and as of yesterday, CG is up about 183%. Now, we hit a peak in August, it was November of 2020, of up 347%. So that's more than a tripling. Now, obviously, we are pulled back from that. So you could say we are in a drawdown. You can see the peak on the chart there, the blue line, and where we are now. It's still an upward trajectory. It's just that for those of you that were with me in 2020, towards the end of the year, we had customers or clients that were, making $100,000 a day in those moves, as the buying was, the selling was so overdone during the pandemic that it was catching up to the end of the year, and then it overshot. Okay. And so as a money manager, I want to stay with the trade as long as I possibly can. But once the trend ends, and it wasn't a secular bull market trend ending, it was a cyclical bear market trend beginning. And I would love to have seen it sooner. All right. But we have adjusted, and we'll talk about that again when we talked about the methodology at the end. So from Albert Einstein, do not worry about your difficulties in investing. I assure you that mine are far greater. So no matter how challenging we think this is, those of us that are managing money for a living, believe me, we think about this all the time, 7 days a week, 365. It never gets away from us. For those that go on vacation and say they don't think about the market, I don't believe them for a minute. That's just me after 32 years of doing this, okay? All right, so where do we go from here? The employment scenario. Do we have positive news? So that's the actual what's going on. You've seen how CG is doing. We know where the market is today. Still vacillating, working through that moving average situation. We got through that downtrend, but now the bears are trying to bring it back below that to show that as a false breakout. I do not think they'll be successful, but earnings continue to come in, and if they continue to disappoint, we stay well under that 73 percentile, then it could be a little bit more bumpy road. But overall, a lot of the negative sentiment has been shaken out. So where can we find negative news to support the bear case? All right. It's not with employment. All right. So the survey was for 188,000 jobs. The actual was 517. Talk about a miss on the economists. Look at the red bar. Just crazy. A great number. So why didn't the market like it? Because the market, believe it or not, wants to see things negative because they want the Fed to lay off the interest rate increases. Well, at least at the last one, the Fed only rose at 25 basis points. We'll get to the Fed in just a little bit later, but this is great data. The non-farms payroll number, look at the chart here. And if you can just kind of take your eye and take that upward line, the straight dive down, of course, is the massive number of jobs that we lost when the economy shut down in February, March, and April of 2020. But now we're back to that trend line. You kind of have to fill in the blank space there with your eyes. But jobs are just rocketing. It's really hard to have a recession when you have job growth like this. The unemployment rate set a 60-year low. And yes, for those of you that think that Donald Trump set records, he did. But the Biden administration, they're in office, whether you want to credit them with this or not, the reality is that the survey was for 3.6% unemployment and the actual rate was 3.4. That is, we're going to just call it almost lifetime lows here. You got to go back to the 60s to see it that low. Theoretically, it'll never be zero because there's always going to be somebody out of work, all right? But it's approaching that theoretical low. In fact, 10 months in a row now, this is a great number. Payroll figures surprised to the upside for 10 months in a row. You won't hear this on the news. But again, where's the bad news? This is the employment scenario. I started this segment by saying, how can the bears make a case that we're still in a bear market and we're going to stay in this and inflation's going to keep rising and we're going to go into a recession? Well, in the payroll data here, I'm not seeing it. Are you? This is the actual data. It's footnoted in the lower left-hand corner. If you want to know the sources, watch the show again, check my sources. All right. This is encouraging. So average hourly wage earnings for January, what segment of the work industry here showed the greatest increase? Leisure and hospitality. Who got beat down the worst 3 years ago when all of restaurants and flights and everything were just shut down? Airlines, restaurants, lodging. And now we're seeing these jobs continue to increase. This isn't the first time I've seen data this strong for leisure and hospitality. But again, hard to say we're going to be in a recession or have massive inflation killing us in the market when there's this much hiring going on in that sector. So we didn't see it in employment as far as a case for the bears, right? Let's look at inflation and see if we can find a case for the bears here. All right. So the U.S. near a consumer inflation expectations lowest in nearly 2 years. So this is dropping. Now, this isn't to say that inflation is low, but the trajectory is heading down. And that's what we want to see. All right. So consumers are expecting inflation to drop. All right, we hit a peak of 5 point, actually it's much higher than that, 7%, but this is the expectation graph, not the actual inflation graph. Let me get straight on that. We want to see this. Sometimes you want charts going higher, right? This is one you want going lower. We want to see the expectation. Why? Because if consumers believe that inflation's coming down, what are they going to do? Spend, 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 and that's a good thing. Let's compare this to previous cycles where there was high inflation. Anybody remember 73, 76, the Nixon years, 78 to 82, the Carter, early Reagan years. So you can see the hump there and what happened. The black line is the Carter years, 73 is the Nixon years, and red is where we are right now. So we never hit those levels from the 70s and 80s, and yet we're already turning over. Again, on this graph, we want to see a lower number because the number on the left-hand side is the rate of inflation. We want to see that down. We don't want it to be zero, by the way. I mean, or else you'll buy a house for $300,000 and it'll still be worth $300,000 a decade from now. We want a little bit of inflation. In fact, the Fed's target, I probably said it before on the program, is 2%. When Donald Trump left office, the inflation rate, look it up with the Bureau of Labor Statistics and with the Treasury Department, is 1.7%. Okay, we rocketed to 7.4 for a lot of reasons, which are beyond where we're going to go in this particular segment. But we are on target to see inflation ebbing, and we are in a better place than we were during 73 and 76, 78, 82. And what happened during both of those times? Did we make it to the other side? We did. Okay. 2022 Consumer Price Index. This is the same sort of scope that you saw in, let me go back to this target here, but this zooms in a little bit on the numbers a little bit better. So when they talk about the Consumer Price Index, all right, they're showing a trailing year. So look at March where you see 8.5. That means that if you look back to March of 2021, the inflation rate is 8.5% March over March. April over April, and it hit its peak in June of last year where it was 9.1% year over year. And since then, it's been dropping. Obviously, 7% still too high, but the trajectory of where it's heading is what we want to see. Okay. There's no way you're going to be able to see all this data, but I really like this chart. So hit pause either now or the next time you watch it. The inflation rate, we just mentioned 7.7 in the U.S. It makes you feel like, gosh, it's really, really high. Well, it is high compared again to the previous administration, but look at these other countries. The darker the color, the more serious things are. For instance, I'm going to lean in because even I've got to lean in here. Venezuela, 156%. The Sudan, 183%. Iran, 52%. Russia, 12.6%. Are there a few countries that are lower than the U.S.? There are. Is the preponderance of the world at a much higher inflation rate? They are. And that is because we are still the dominant economy, stability-wise, GDP-wise, and low inflation-wise. Even though 7.1 is not where we want to be, we are far better off than all these other countries. I think that's a great thing for the USA. All right. So the Bears lost their case on inflation. What about on the recession front? Okay. They didn't win with a bad jobs report. They didn't win with a bad inflation report. I'm showing the data that still looks bullish. What about recession? Okay. So from Bloomberg and T.S. Lombard, both great sources, what is the expectation for the next U.S. recession? Well, 2023 basically is the lowest, smallest, shortest, okay, you following all that? Lowest, smallest, shortest U.S. recession probability since 1949. All right, I know that's a mouthful, but the reality is this is really looking positive. Now, could all these economists be wrong? They could be, but the data supports this, that even if we have a mild recession, and we could well be in one, I've been saying, frankly, for almost a year that we've entered a very mild one, all right? But it's not enough to shut down this economy. So market implied odds of a recession are dropping. So look at the black. The black says in October, what was the expectation of a recession tumble? And now in January, just last month, what is it? Well, what you want to see here is the orange lines farther to the left than the black lines, which that means that the recession predictions are receding, all right? In the S&P, credit, base metals, because you're looking at inflation in a lot of different places, all right? And the chances of a recession would affect all of these industries, treasuries, euros, 5-year government bonds, all right? So that's the only place where it's actually large if you look at the very last one, but that's in Europe, okay? There is no sector of the U.S. economy where the yellow or orange, whichever it is on your screen, bars are farther to the right than the black ones, which means that the sentiment is dropping, and that's what you want to see. Again, I challenge you to find any of this data in the news. So I put a little weather forecast here, cloudy with a chance of recession. I'm seeing now less than a 50% chance 2023, and this is from Statista, great company. 20% next year, 16% in 2025. So in other words, Mr. Recession, if you're just going to be a poser and you don't happen this year, you've got a far less chance of happening in 24 and 25. And to me, that is a positive. I'm going to pause for a minute, get a breath of air and a sip of water and see if I've missed any questions. Hey, Andre, how are you, sir? All right, Rapid City, yeah, South Dakota, one of the states to which I have never been. I have been to North Dakota, but not South Dakota. I really like their governor, though. I will say that. All right, guys, type questions when you've got them in the sidebar. I don't need to make this a monologue. I am happy to answer questions. That's why we call it CB3 Live. So, okay, politics and policy. Why do we discuss this? Well, because politics lead to policy, and policy leads to portfolio impact, and portfolio impact leads to personal life impact. So it's inescapable that we have to cover the political implications of what's happening in Washington and to some extent our state governments for the first time in 6 years. Hey, Nellie, how are you? We have a president shaking hands with a Republican Speaker of the House. How about that? All right. I can't imagine what went through those two, their mind as they shook hands there, but there it is, okay? It's a little tough to see this, but this is the number. This is a really great chart from CNN, actually. So those of you who think I'm always biased to the right, I'm using CNN because they're showing the number of minutes that President Biden spent on each of these topics. There's no mention of inflation. Okay, we went from 1.7 to 9 something as of last summer. No mention in the State of the Union, but I digress. There's all these different areas that are being covered. This is a good chart to zoom in on. If you really want to know what's important to the current administration, it would be reflected in the number of minutes that President Biden spoke about them, okay? And the infrastructure is there, healthcare, economy, all kinds of topics. A lot of them I would not have covered, and certainly I would have dealt with inflation, and certainly I would have dealt with the border. Certainly I would have dealt with, Ukraine. There is a little mention of Ukraine in there, but, I'm not giving the speech. So there it is. If you wondered how the speech was broken down, take a freeze frame on this and check it out afterwards. So just one little fact check I thought was funny here. So I stand here tonight. This is a quote from our president. After we've created, with the help of many people in this room, 12 million new jobs, more jobs created in 2 years than any president has created in 4 years. Well, the fact check on that, by percentage, the job growth in Mr. Biden's first 2 years still lags behind that of his predecessors. Notice that's plural. All right. That would be Donald Trump, that would be George Bush, and that would be Barack Obama. Okay? Notice I have question marks for the source. Would you think that this is from Bill O'Reilly or Fox News or Glenn Beck, Sean Hannity? No, it's from the New York Times. How about that? Probably the most left-leaning newspaper in America. So even they had to go in and fact check this. So these sort of things affect us, not immediately, certain like the non-farm payrolls and the other data that I give you, but it affects consumer sentiment, and inflation is hurting those in the lower class financially and the middle class. The wealthy, just keep buying whatever they want to buy. But inflation, and I'm glad it's on the way down, definitely affects America. And it has, because it's forced the Fed to really misbehave, which I'll talk about more when I get to the Fed, all right? So I have a new word for you tonight, a fossilophobe, all right? A person who despises or who is afraid of the fossil fuel industry, a fossilophobe. That is actually from the Welsh Dictionary. You may not be familiar with that. Google it. Fossilophobe, a person who despises or is afraid of the fossil fuel industry. Look, I'm all for clean energy. Just look at Texas and massive outages because the windmills weren't working when it was 15 degrees and ice on the roads again, just like 2 years ago. And yeah, I'm bashing Greg Abbott, and I know he's a Republican, and it's a big red state. But guys, get it together. Don't make the switch to this clean energy and abandon fossil fuel when an enormous state, that would be the second largest state, has massive power outages. All right? But I digress. So there you go. Economic indicators. Let me check the chat here. So many people who watch the speech do not fact check. Yeah, that is true, Nellie. Very sure. Heard it was actually 2 million new jobs. Well, and let me go back and comment. I'm going to toggle back here. It's just us online. Okay, so this thing about the new jobs, remember that the Biden administration is counting all the jobs that came back after we reopened the economy. So the economy was shut down, and in my opinion, very foolishly. 2 to 3 million, 5, 7, 10 million jobs, probably at the very end of it. And those jobs just started coming back. Is that really adding new jobs? No, it's not adding new jobs. Now, that's more of what I'm going to get into as far as digging down into which of those are really new jobs and which of them are just recovering jobs. But fact check, as Nellie says, is a great idea when you watch a speech, for sure, and cross-reference the sources. All right. So economic indicators. I didn't see anything in the employment data, in the inflation data, and in the recession data that point to me that say we are going to stay in a bear market or we're going to have a serious financial decline in this country. I just don't see the data supporting that. All right. That's just me, but I cross-reference and double source everything I put up here. So what am I seeing the economic indicators going for 3 to 6 months? Well, economists continue to upgrade their forecast for U.S. GDP. Now, I would love to see this GDP about 3 to 4%. I don't need to see 7% GDP. And in fact, that's just dangerous because that's what starts the inflation cycle. But 2.5 to 3% GDP with 2% inflation, that means we're slightly staying ahead of inflation. And we do that for about a decade. I'm loving that. And I tell you what else, stocks would love it too. So, and I agree, Martha, fuzzy math. Yeah, we've had that for years in Washington and it doesn't change, does it? So, yeah, what do we got from Kay here? So the 10 mile missing that are missing must be getting free money. Yeah, the 10 million missing are getting more free money. Well, part of the whole, deficit, and I didn't cover this, but I'm going to go off script and cover this now. Biden's talking about, I reduced the deficit. Well, all you did is we're not sending checks out to people anymore. Well, of course that's going to reduce the deficit. The programs ran out. They stopped paying out. Well, of course the deficit got reduced, but that's not truly deficit reduction. And in fact, he spent more than any president in history. And he's not done yet, all right? But I digress. Still, it's important for you to know this. Fact check it. Bloomberg's Financial Condition Index, this has to do with payment of flows, mortgages, debt structuring, etc., rocketing back above the zero line. Loving to see this. October was the low, which incidentally was the low of the market. So people's sentiment is getting stronger here. This is a good number. All right. Really good number here. Total consumer credit. If you look at the little purple dot there, we are now, remember the trend lines? I've been showing you trend lines tonight. There's the downtrend line from the stock market that we broke through, all right, just a couple weeks ago. And then here's an uptrend line, all right, where we took a dip in 2020 as far as consumer credit, but now consumers are spending again. And we have now exceeded what that trajectory would have been had COVID never happened, all right? That's a positive because consumer spending is 68% of GDP. The rest of it is split between government spending and corporate spending. The consumer drives America without a doubt. Part of the reason that they're spending this kind of money is because they're taking it from savings. Where did they get the savings? Because when they were getting those checks, when we all were getting those checks, many people were not spending because they didn't know how long this pandemic was going to last. They were building up their savings account to crazy high levels. Okay, $2 trillion in savings because of so many checks going out. All right. And now they're spending it because they're confident. Again, consumers making a statement here that we're not going to have a bad recession. We're not going to have serious inflation ticking back up again, that hump has turned the corner, which I've shown you in multiple graphs earlier here. Breathe. The Fed, Jay Powell. Oh, man, I don't know about him. I really don't. There's an old saying, so be careful what you root for. You might just get it. We rooted for good news. In this case, the investors really wanted terrible news because that might get the Fed to back off from blowing up the economy. All right, already on our back foot. That's what the economy has been. And yet the market's still resilient. All right, broke through that downward trend line that I showed you very early in the program. The market continues to struggle with all this news. It struggled today because now, behemoth earnings reportings are coming out, and it's just hard for the market to get traction. So it broke through that trend line, but it's going to need some more big trillion-dollar companies to come in with strong earnings and more continued good data to keep the upward move. The 4,300 level is what we're looking for in the S&P 500 for those of you who are watching the technicals. 4,300. Let me stop over here, like losing 2 pounds, gaining back, losing 2 again. Yes, very bad for the heart to have that weight up and down, up and down, up and down. Is the housing market in Nashville still strong relative to the rest of the country? Well, we think so. The data that I saw today is this is the 4th busiest market in America behind Austin, Phoenix, and actually someplace in California. So yeah, it's still very strong. Actually, you're even seeing inner cities. I mean, when I say inner cities, Chicago, Cleveland, there are cities where buying has picked back up because prices got so beat down during COVID and, of course, the mass exodus from the blue states down to red states. Yeah, you're still seeing that. So what are my thoughts on consumer credit debt increasing? Does that impact things? It was a little bit of a scary number to see that rising as fast as it did, Nellie. Consumers are always going to spend. We Americans are famous for what I actually coined a phrase. I don't know if I coined it, but I used it for years: deficit lifestyle. So we spend beyond our income. All right. Americans seem to have no problem carrying consumer debt. And the government played around with this in 2011 when they revised the tax code, where there were a lot of things that we used to be able to write off on our income taxes that we can't. And yet it didn't change people's spending because people want what they want. All right. So I hope that we don't see ridiculous exuberance, because that would drive inflation back up. And I want to see that curve that I showed you earlier tonight continue to drop. I'm going to show you something else here from the Fed in just another slide or two. All right, so the Fed wants the news to be bad so that they can continue to lower. But if it's really strong, then they're going to say, we're going to just keep raising. I think that they would max out at 5.25, but honestly, I think the Fed is just about done. And that's why the market had such a strong burst after the last Fed meeting when they raised it 25 basis points. In the meeting afterwards, someone said, are we approaching disinflation? Jay Powell paused for about 4 seconds. I don't even know if it was 5, and cleared his throat. And the Dow jumped 250 points in the next 5 minutes. I mean, that's how people are watching, not even for the words that come out of the Fed chairman's mouth, but the body language and the facial expressions. It's crazy, huh? So most central banks in the world are expecting rate cuts. So the black bars mean what's the change in the next 6 months? You can see they're all going up. What's the change in the following 6 months? In other words, months 7 through 12. Well, across the world, the Fed, ECB, that's European Central Bank, Japan, UK, Canada, Royal Bank of Australia, etc., Royal Bank of New Zealand, these are all big Western economies. They're all seeing interest rates dropping, and that's what we want to see. Hey, Deb, how are you? Unable to get here? Will you watch the beginning of your show later? There you go. All right. So this is why we had the shock, and I highlighted it so it's really, really clear. Market participants, whether they are economists, whether they are hedge fund traders, whether they are endowment, family offices, whether they are huge pension funds, they want to see incremental change from the Fed. So look between 2016 and 2020. Those are quarter point steps. All right. This is what Greenspan was famous for. He would raise consistently for a year or more, but a quarter at a time. Well, Powell got behind the 8 ball. He left it flat for too long at basically 25 basis points. You see the flat line down there. And then there's in red, those are the massive 75 basis points increases, 5 in a row. So he got to the target that he wanted, but the problem was that he wounded the patient so badly that we're just hobbling now. And yet the market is still pretty resilient. But this kind of behavior should never be happening from a Fed. It just shouldn't. Market participants don't want to see it. They don't know when it's going to stop. And it just brings tons of volatility, unneeded volatility to the stock market. And I hope Jay Powell learned his lesson. This is the chart that I find most interesting, and I hope you guys do too. So the black line I don't really care about, but the green line is what the Fed, the FOMC, that's the Federal Open Market Committee, what their forecast is for interest rates going through December of 2024. Not this Christmas, but the next Christmas, so 22 months away. They're saying Fed funds rate's going to be around 4. Well, Nomura, again, these guys have been predicting interest rate trends for decades, thinks it's going to be back to 0.75. So if you've got a 7-year mortgage, you've got a 7% mortgage, you could be refining at 2.75% to 3%. Maybe. That's absolutely doable in 2 years if they're correct. And I assure you, I will be following this because markets love low interest rates with low inflation. That is nirvana for stocks. And that's what happens in secular bull markets. Secular means multiple business cycles, longer period of time. I've said many times, the very first chart on the show tonight, 2013, April 10th, 2013 is the beginning of the secular bull market. I think we're on this till 2033. 2033. We're halfway there. All right. Housing market. Tougher to save for a down payment. I haven't really presented this, but 2022 is showing the orange dot, the orange line here. It's the toughest year in a long time. And somebody asked, what are the strong markets? So there's Nashville. It's fourth, not first. Los Angeles, second. All right, so this is where the surging home prices, and that's because people are buying there. Miami, Nashville, Phoenix, New York. It's just getting tougher. It just takes longer. It could take people a decade to save for a home. I don't think houses will stay in this range for that much longer. I think that we will see them settle back down again. We're already seeing this somewhat in Nashville. I mean, our house, for instance, is $100,000 less than it was back in October or September, I guess, which was its high. So, but it's still good. I understand it takes longer to save, but you may see banks then liberalizing their down payments to 5%, and then we start this whole 2008 thing all over again. But I digress. We aren't there yet, okay? So the number of distressed home sales stays really, really tiny, 1%, all right? That's a good number. That's a good number, all right? Which is better, stock market or real estate? I showed this last week. I don't think people paid that much attention to it. At least I didn't get any questions on it. But if you want to go back and check the data, the stock market consistently has outperformed real estate as an investment. All right. And that is why a lot of people will say to me, well, don't you pay cash for homes? Well, actually, I did that one time. And it was in 2014, which was 1 year into the secular bull market. And that was a really dumb move. Cost several $100,000 in market gains when I should have been leveraging on my house. But this is another discussion for another time. But if you want to talk about that and why I believe that, I'm happy to talk with you. But stocks are where you want to be. Certainly liquid assets. Could be commodities. Not so much on crypto these days. Okay. You've noticed I haven't talked much about that. But certainly liquid investing in U.S. stocks. I think Europe stocks and actually our one program that trades on the Tokyo Stock Exchange is doing real well. Because the yen has been particularly strong. But we'll see. Currencies have been really volatile since the world's trying to figure out what the Fed's doing. I mean, the Fed just wags the whole world. It really does. So last month I started this segment on our methodology and went through that in detail. I just wanted to highlight a couple things from the last time and then bring some new data. So top-down investing is what I do, is what we do, which means we look at the top. And the top meaning what's going on in the world. Where are interest rates? Where is growth? Where are the major indices? And then where are the sectors? And then we'll look down at individual stocks in the sector because we want to pick the strongest stocks in the strongest sectors in the strongest countries. Make sense? Bottom up investing, just the opposite. I like ABC company. Well, what sector is it in? What's my risk in the sector? Well, what country is invested in? Is it on the U.S. Stock Exchange? Is it on the not Bank of England, but the Life, London Life, or the CAC in France? Where is it? I mean, do I have risk there? So they start at the stock and move up. I just have never found that to be a smart way to do it. So that's why we're top-down investing. And then we look at each of these areas. You guys have seen this collage every single show, all right? So unemployment, inflation, recession, politics, economic indicators, the Fed, housing. I mean, all of this goes into our decision-making process on what we select for you. And as I said last time, you can't see everything here, but what you're seeing is a group of stocks, in this case, about 70 of them. And if you can look real carefully, you'll see blue. Blue and green are good colors. All right. So I am screening for stocks that are strong with moving averages, with parabolic, with what I call stop and reverse, with Keltner channels. These are just technical explanations or technical entities where these stocks are strong. Now, it can be strong one day and then 2 weeks later, it's not. Now, it normally doesn't go from strong buy to sell, but it could drop to a buy. And so we are continuing to filter and screen stocks in our two programs, GI and CG, to find the strongest stocks, and in GI in particular, dividend producing stocks. And we just weed out. We do not let any dead weight stay in our portfolio. There was a time when I was managing what I would hold on to a great name, hoping or expecting it to come back. And I did not do that with Tesla and got rid of that early, but I did do that a year or so ago with Facebook, and that was expensive. So now we have different processes in place, and this is what I've told you earlier in the program that I was going to cover right now. So what has changed in my methodology since October 2022, that's my second typo tonight, guys, sorry, is I'm no longer willing to risk a target of more than 1% of portfolio equity in a single position. That means I'm not buying stocks with a 4 or 5 or 7% holding anymore. I'm just not doing it. Now, could that change in the future and I could go back to that on exception? Possibly. But what this limiting of size to 2% or at the most of 3% of a portfolio's value, it means that on a $100,000 portfolio, if I buy ABC stock, I'm risking $1,000 in that stock. That tells me how many shares I need to buy. So I don't go and say, I really want to buy 100 shares. No. I really want to risk no more than 1% on this stock. And if that means buying 87 shares or 42 shares or 113 shares, that's what I'm going to buy. All right. So as a result, though, because there are no, huge holdings that could, hit a great earnings. I mean, obviously it'd be great if I'd been long Meta the other day when it's up 25%. I have had some winners like that. I actually showed that last month with AEHR. If you want more explanation on that, happy to give it to you. But the growth can be slower because the drawdowns are lessened. All right. And as we pull out of this pretty deep cyclical bear market, all right, still less of a percentage drop than we had during COVID, but it has lingered. It's the psychological lingering of 13 months of this, and we're not done yet. I think we're pulling out of it because we've broken that trend line, which I showed you earlier in the program. But I am just not willing to risk more than 1% of the portfolio on any one holding. So, and again, you'll have to freeze frame this and look at it offline. But this basically is the last 3 or 4 months history in CG. So the green bars represent profitable trades, and it's been a pretty good time. They're not huge profits, okay? So if you look at those numbers below there, again, you'll have to freeze frame to see it. But what I'm looking for is a ratio of at least 3 to 1 in my winners. So for every dollar I lose, I want to win $3. Well, right now I'm at 4.2 to 1, which is a really good number, okay? Now, to do that, I have to do a lot more trading, and I have to get rid of the losers. So if you can look on the screen, you see the return percentage. If you lean in, you'll see it, okay? What I'm looking for are the number of winners. So the number of winners, the percentage of winners is only 26%. 70% are losers and about 3% break even. All right. But I don't care. Psychologically, there's an adjustment to that because you're losing more when you're winning, but the percentage that you're losing is far, far less. Because my goal is to cut the losers at 1% and let the winners like AEAR or ELF, which is a cosmetics company, turn into what Peter Lynch used to call 10 baggers. So you risk $1,000 and it turns into $10,000. So when you buy a stock, you know what your risk is. All right. So that's really your investment. You might say, well, I just paid, $30,000 for that stock position. But if I'm only going to risk $3,000, right? So then that is really what I'm investing, because the rest of the capital is just there because I need that. I'm not going to sit there and risk that whole amount. I'm risking $3,000. So if I make $12,000 on that, that's a 4-bagger. That's a good return. And that's what we want to see with a fixed risk. Okay. That's the substantial change from a year ago. All right. So then we look at this. You see all the green on the screen. These are all the winners. Ranks everything by day. If you guys that are clients, even if you're not a client, I'll share this with you. But if you're clients, you want to know what are the winning stocks, what are the ratios, it's all here. And I, to be fair, have to show there's plenty of red ones too. But if you can lean in and see, the numbers are smaller. And that's because I have a zero tolerance policy with stocks. I do not marry my stocks. I date them. Oh gosh, that's a Warren Buffett line. So anyway, there you go, guys. I'm going to get a sip of water here. If you guys got any questions, type them in the chat now. These are the topics we cover. Do it every week. Reviewing these every week, and then I bring them to you every month. All right. I hope it's educational. I hope it's informative. I hope it gives you confidence that we are still in a good place in this U.S. economy. Reminding you, and this is the same typo, I'm sorry, it's Thursday, March 2nd. 3 weeks from tonight will be our next show here because I'll be traveling on the 10th. All right. Don't miss it. You'll get the update. Again, that's a reason to subscribe to the channel. Click the bell so that you get those updates when we go live. All right. Watching for any questions. Let me get a sip of water here. All right. How many of you watched the State of the Union? Anybody? Comments on that? I don't know. Did it teach anything? You know, it is, after all, you know, the most important thing where the administration can put its achievements in front of America. So anyway, I'd be curious as to your opinions. Feel free to contact me, obviously, anytime. So I always end the program with this. For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. Thank you, Timothy, for sharing those words from us. And of course, that's gospel inspired, and Timothy's quoting Jesus there. So my thoughts on JP Morgan Chase's warns today of massive disconnect in the stock market. I'd need to know more about what a disconnect means. You know, JP Morgan, great company. What is a disconnect? I mean, I follow this every day, almost every hour. I don't know what the disconnect is, but, you know, I pay attention to what those big brokerage firms say. So share the link with me, Charles. I'll bring it up on the next show. All right. So guys, that's it for this month. Any questions? cb3@cb3.com. You've got my number on the website. We're heading into the third month of the first quarter, so earnings will slow down. You know, still a pretty good month. February is actually not as strong as January. March turns back to being pretty positive, and then April, and then there's the whole sell in May and go away. None of that, I believe. As you know, I've covered that every year. But stay with us. Contact me anytime with questions. Tell your friends about the show, please. We'd love to have more people watching. Take care of yourselves, and I will be back in 3 weeks for the next show. Remember, at CB3 Financial Group, we don't just manage your assets. We become one of them. God bless. We'll see you next month.